Hello, everyone, and thanks for joining us for the Business Brainwaves again. So this is the Business Brainwaves for March 2022, and it relates to the budget speech that happened in February 2022. Now, the purpose of this masterclass is really to discuss with you the highlights in my mind that will impact smaller businesses, so medium, smaller businesses. It will obviously also impact the bigger businesses. But as we know, with my followers, most of my clients, those are the smaller and medium business clients. And I decided to look at what happened in the budget speech, what is pertinent to my clients. And from there, I picked certain topics in that budget speech that I believed would be of importance to my clients. So let's look at what we will be running through in this class. Okay, just that's me again. For those of you that don't know me, you can get me on Noble Prosperity. You can also follow me on LinkedIn. I do business optimization, tax, estates, and trusts. So what we will cover in this session is we will look at corporate income tax. There is some changes there. Turnover tax, and here we are talking about micro businesses. We will just touch again on what is a micro business and what does the tax look like there. The SMMEs, those are your medium-sized businesses, the small and medium businesses. Dividend tax, and you may go, well, there's no changes on dividend tax. Why are we even looking at that? Well, all will be revealed. Personal income tax. Why is personal income tax important to your business? Well, if you're employing people, the personal income tax rate impacts your business. And of course, it impacts you as you are also paying personal income tax. The employment tax incentives that you may benefit from. How fuel prices and levies may impact your business. And then, of course, we've got VAT. So let's dive into this. And off we go. So, as we know, there's been big talk with regards to corporate income tax and this big hoo-ha about, taxes changing from 28 to 27%. Well, for those of you that are in the know, it is still much higher than our brethren that we do a lot of business with, where a lot of the tax rates hover around the 24% mark, 24 to 26% mark. So we are still higher, and government is trying to maybe be more tax friendly when it comes to businesses. But as we know, as we giveth with one hand, so the hand extends to take on the other side. And that is where the limitation rules come in. So please don't get too excited about this. Oh, I can now save the 1% tax. Because at the end of the day, yes, although the tax rate will drop from 28 to 27%, we need to understand when that happens. So let's first look at when does that kick in. It is effective for companies with a tax year ending before or on, so from 31 March 2023. So only with companies with a tax year end March 2023. Okay, so before that, we are still on the 28% tax rate. So it's not with immediate effect. Number one, you need to take that into account. And if you think about how many businesses run from a February to a February year end, where that is a rule, then you need to take into account that it doesn't kick in immediately, possibly for your business. So that's the number one thing you need to remember. This rate of 27% kicks in for businesses after 31 March 2023. Okay, so number one. Then there's this limitation rule. Man, and did I have to do a lot of research on this limitation rule to actually get the true facts of it. because there's little bobs of information on it. But to get the true effect of it was quite challenging for me. And I do a lot of research. I love me some tax. For those of you that have been following me for a while and that have attended some of these masterclasses, you guys know how much I love me a sum and some tax. So for me to say that I really had to go and scratch deep and long, and that's why it's taken me so long to actually do this recording even, is I needed to really get down deep into what are these limitations. And a lot of people are saying, yes, it is still draft legislation. Not actually true. It has now actually become legislation. Okay, so that's also something we need to take into effect. And I'm going to read to you what the limitation rule is. Okay, so it's important to note that the commencement date for the reduced corporate rate will coincide with the assessed loss limitation rule, in terms of which corporate taxpayers will only be allowed to claim assessed losses against 80% of their income, as well as with the cross-border interest limitation rule, where the deduction will be limited to 30% of tax EBITDA. Now, I'm not going to touch in this class on the offshore or the cross-border, I should say, interest. That'll be a discussion for another day altogether. I will, however, look at the limitation of assessed losses, because I think that's going to touch far more of my clients at this point. But it is important to know that this is now in effect. Okay, so this actually became effective 1 April 2022. And that is why it was so difficult for me to get information on it, because it only became effective as per the Tax Law Amendment Act of 2021, and it was effective 1 April 2022. So again, it is now effective. So you need to understand that. So if I'm going to claim the 27%, and there's not an option, oh, I want to go with 27 or 28. No, that's not an option for you. Effective, if after 31 March 2023, our tax rate drops to 27%. But the minute that monkey kicks in for you, you will then be limited to the assessed losses. So what does that limitation on assessed losses look like? Okay, so this is where we need to understand what we are looking at. First and foremost, we are talking about the carried forward assessed losses. Okay, so things that we've been dragging with us from history, last year, the year before that. And what it actually says is that we can claim a maximum of 80% of our loss. So I'll give you an example of this. Okay, so if I've got a tax income for the year of 2 million, okay, so we've got 2 million of income, of taxable income, with a carried forward loss of 5 million. Okay, so I'm in a profit situation now. I've made a turnover of 2 million. So for this year, I'm now in a profit situation, but I still have a carried forward loss of previous years. So what would that have meant for me? Previously, I would have been able to offset my profits against those losses 100%, and I wouldn't be in for any tax. Okay, so I wouldn't pay any tax until I had eaten up that entire loss. Not so much anymore. Now what will happen is I will only be allowed to claim 80% of that assessed loss, but it is limited to the 80% of my taxable income. So it's not 80% of my loss. No, it's 80%. It's limited to 80% of my taxable income. So I've got a 5 million carried forward loss. Sure. But I had a turnover, an income, taxable income of 2 million. So SARS says, not so fast. 2 million times 80% gives me 1.6 million. So of my 5 million loss, I can claim 1.6 million loss against my 2 million this year. That leaves me with 400,000 that is now taxable. And it's taxable at 27%. So you see what happens now is I land up having to pay 108,000 in tax. And that now results in a cash flow issue for me. Because before, what would have happened is I wouldn't have had to pay any tax because I had this whole 5 million that I was carrying forward. So every year my tax guy would say to me, don't worry, man, we still have those carried forward losses. So even if I made a profit this year, I wasn't worried about paying taxes because I still had this bag full of losses over my shoulder and I was carrying it with me and everyone was happy because although I was making a tax profit this year, I still had my tax losses against which I could offset it. And then everyone was going, no, don't worry, man. You can offset it against 80% of your losses. So if I had a 5 million loss, I could claim 80% of my loss, which would give me 4 million. I only made 2 million profits, so I would still be good. It's not correct. It is 80% limited to your income, so the turnover, the income. So you see, what will happen is you'll land up paying tax. And now people go, but what about my loss? You're not losing it. It's still rolling over. Problem is, it's creating a cash flow issue. Because from somewhere, if you were not mentally prepared for this, financially prepared for this, you're not going to have that money. Where you're going to get 108,000 Rand from all of a sudden to pay SARS if no one prepared you for that. And that is why this is so important to me, that people get this, that you understand this, that you are financially and mentally prepared for the fact that you are now going to pay tax. So you need to understand this. I will also post an article on this on my website, in my blog, so that you can go with actual examples for you to go and look at, because I think this is really vastly important. It's so important for me that my audience gets this. Okay, so very, very important that you get that you will now be liable for income tax. Now, of course, if you are running at a loss this year, again, there's no tax to be paid. Because remember, the carried forward losses is what is counting here. It is not to do with having a loss this year, that you can only claim this year's loss. Okay. The one thing that the jury is still out on is we don't know yet for how many years can we run those losses. Because what happened is SARS had come forward and said that they wanted to run it for a certain number of years, and the accounting fraternity then went back to SARS and said, hold on a minute, what do you think are you doing? You can't just come to us and say, you're now going to write off these losses. You gave us the ability to claim losses in production of income. Yes, yeah. Now you are telling us we've run at losses. Now you want to say, but we can't claim it, you're capping it. As what do we write it off now? And SARS has not been able to come back with answers yet. So they've not published for how many years can we run these losses. And once we've obviously got an answer on that, I will gladly share this information. But at this stage, we are not 100% sure for how many years we can run these losses. Like I said, this was only published in the Tax Law Amendment Act, effective 1 April 2022. So it's still fairly new. It's difficult to say when SARS will come to us and say, effective how many years we can run these losses. At this stage, we're running them. Okay. So that is my story on the income tax changes. So effective companies with a year in 31 March or after 31 March 2023 or after, our tax rate drops to 27%. The limitation rule will apply. The limitation rule means the following. We can claim 80% of, we can claim our assessed loss carried forward, limited to 80% of our taxable income of that particular tax year. Okay, no matter the size of our carried forward loss. Now, there are other limitations. If our carried forward loss is less than 80%, then you would claim the full value. And there are certain examples in the explanatory note from SARS on that as well. So there are, if your loss is less than 80%, then you would claim the loss. If your loss exceeds 80% of your taxable income, then you would be limited to 80%. Okay, so that is the income tax. Now, next step, turnover tax for micro businesses. Short answer, nothing's changed. Okay, so here, what I can tell you is that the micro taxes has stayed the same. Now, what is a micro business? Okay, a micro business is a business that turns over less than 1 million rand a year. What is this whole story about a micro business and why does it pay less tax? Because SARS decided, hold on, for businesses to keep track of all the money in and out and all the invoices and everything, it is very onerous and it becomes very costly for small businesses. Bookkeepers, accountants, tax consultants, these things become costly. So in order to assist small businesses and to boost the informal settlement, let's call it, or the informal trade, rather I should say, they came up with this micro business turnover tax concept, where it means the following. You do not have to supply us with all the slips for expenses because we're not interested in expenses. You will pay tax on turnover. So all the money that came in, that's it. There are certain limitations, and I'm not going to go too deep into that. Suffice to say that if you had spent certain amount of money on buying assets, you may have certain deductions. Okay, but for the normal in production of income expenses, you don't have those expenses in this type of tax. So when you register for turnover tax, you have to specially register for that with SARS. It's a specific type of registration. When you register as a micro business for turnover tax, it means SARS is not really interested in your slips. They're not interested in your whatever was in and out. We look at what money came into your bank account. We take that as trade income, and you are taxed between 1% and 3% on turnover. And that is it. So you will pay them as per the tables set out on the slide. You will pay these rates of tax. So as you can see, there is no change from the previous year. So your 2022 tax and your 2023 tax would remain the same. And you would pay up to 335,000 turnover, you would pay zero tax. So normally people with hobbies, things like that would fall in here if you registered it as a micro business. And so it would climb. And yeah, so that is all I need to tell you about a micro business. Long and short, if you earn less than 1 million and you do not want to keep up with all the slips and the money in, money out, you register for turnover tax. You have to, there are certain requirements. You can go onto the website of SARS. You can also go onto my website and have a look. I do have certain information on my website on that information as far as micro businesses are concerned. Okay, next one, small businesses. Okay, now there is a change here. As you can see, we've got the 27% kicking in here. So same thing applies. Because small businesses have the sliding scales up from 0 to 28%. What will happen is when the changes come in for the business tax to drop down to 27%, of course, that will impact our small businesses as well. Just a reminder, what is a small business? Well, those are the businesses that turn over less than 20 million a year. And again, we've got certain criteria. Must be a natural person. You must have your income from trade, certain limitations on fixed asset income or interest income. So yeah, there are certain criteria for that. You would know if you're a small business. It's again a specific registration. You cannot necessarily be registered as a small business corporation or an SME if you are what is called a PSP, so a personal service provider. More of that information, again, also on my website and of course on SARS's website. The purpose of this discussion is to talk about tax and not the qualifications or classifications of these businesses, but just wanted to touch on it to remind everyone. So small business, those guys that do turnover of less than 20 million a year, ownership in personal hands. You cannot have your shares in a trust. You fall outside a small business. You cannot be a personal service provider. Your income is from trade, not from assets or interest. Those kind of things. So there are certain limitations. But biggest change here, we're looking at the 27%. Okay, goody gumdrops. Let's have a look, see what is the next thing. And let's look at time. How long have we been going here? Oh, okay, we're getting through this nice and quick. May actually give you back some of your time. Okay, dividend tax. And as you can see, let me get my face out of the way here. Okay, with dividend tax, what we need to understand, although the actual dividend tax rate of 20% has remained unchanged, there are certain impacts that we need to take into consideration. So that's why I say here, yes, the rate remains unchanged, but, and there's a but there. So before I get to the but, let's look at what is dividends tax. Just let's remind people again. So we have the great privilege of paying income tax on our business, and that's the profit tax. So when we have our income, less our tax deductible expenses. So what is that? Expenses in production of income. That is normally our Section 11 expenses. So I sold something and I had an income. So that is my income. But what did I have to do in order to get that thing to sell? So that may have been my rent, my staff, my purchases, whatever. Those are my expenses again, if it's not stock. Those would be my deductions. Then you've got your profit. Now that's your CIT, your corporate income tax. But when I then want to take a portion of that profit out of the business to the shareholder as a dividend, remember the shareholder is taking part of that profit, and I then declare a dividend, that dividend carries its own tax. And that's not a double tax. Remember, the company paid its tax. Now the party receiving this money, this profit, the shareholder, the member of the business, that person is now liable for the tax as well. However, to make things more streamlined, SARS said, hold on, even though the shareholder is receiving the money, the onus rests in the company declaring the dividend to pay over that tax. That is a dividend tax. Now, the rate of that dividend tax changed some years ago from 15 to 20%. Now, that rate in this budget speech stayed at 20%. So that rate has not changed. And that is what a dividend tax is. It is the tax we pay on taking a profit out of the business. Okay. Now, so the rate hasn't changed. So why am I even talking about this? Remember that when we change our rate from 28 to 27% in the company on the corporate income tax, the effective rate of a dividend to the shareholder will in effect change. Because how does the dividend work? So if I've got a 100 Rand and a profit in my business, and I pay 28 Rand tax on the profit, I've paid 28 Rand. I then pay a further 20 Rand on that money to declare dividend. The balance that comes to me is then the shareholder's profit. So that's the dividend. That's really the net effect of what I'm trying to achieve with my business. Now, so that would have been then my effective rate. Now, the same applies. If I pay 27 Rand on the 100 Rand, and then a further 20 Rand to pay the declared dividend, do you understand that my effective rate has changed? So that's all I wanted to say, is that even though my dividend rate hasn't changed, my effective rate has in fact changed. Now, very interesting thing that we also need to take into account, and which I don't think maybe business owners often realize, because it doesn't get discussed with them until of course, a tax is payable. There are things like deemed dividends. And a deemed dividend means I've done something, taken something, assumed something without calling it a true dividend. In other words, I didn't take money, physical money, from the company's bank account to my bank account with the name tag dividend and paid dividend tax on it. So in my mind, it wasn't the dividend. Not so fast, says SARS. And I'll give you an example of one of those. And I love me again a little act. And I quote, Section 64E4 of the Income Tax Act. That one specifically relates to loan accounts to connected parties. Now, what happens here? Often, shareholders, directors, will take money from the business as a loan. So what are they? They're connected parties, especially shareholders. They're connected parties. Or even their children. So for instance, rather than daddy taking a higher salary to pay for overseas studies for a child, they decide, hold on, because it's dad's business, they're going to extend a loan to this adult child to go and do a PhD overseas somewhere, because the child fully intends to pay the money back. That's a connected party. So it's a loan out of the business. Because now dad doesn't have to increase his salary and land up in a much higher tax bracket, but the company can also not actually employ the child because the child's not employed. They're working overseas towards a PhD. So now they decide, okay, we're going to do a loan. Nothing stops them from doing the loan. But they don't charge interest. And in there, SARS says, wag so bietjie. You've now created a deemed dividend. Because what have we done? We've created a benefit. And on that portion of low interest or no interest, that is the actual deemed dividend. And on that, you will pay dividends tax. What? You say to me, are you insane? I go, no. Sometimes this may be a better option. Because if you think about it, if I have to charge interest on that loan at the given rates that we have to, what happens is this loan keeps growing and growing and growing, and now it's interest on interest on interest. So we're compounding the interest on top of it. So what happens? This loan account just keeps growing. But if we're saying we're not charging interest, but we are quite willing to pay the dividend tax on the deemed interest not charged, we're paying 20% on the interest that should have been charged. Isn't that a better deal? Isn't that like a better sum? Isn't that like a better outcome? Now, I'm certainly not saying this is what we should all do. Horses for courses. I'm saying when we sit and do tax planning, we need to look at what does the Act say we can do? What does the Act say we are not allowed to do? Who are we allowed to do it for? When are we allowed to do it? What are the benefits and what are the costs? And at what point am I reaching my sweet spot on paying the tax? Because tax I'm going to pay. But is interest, income tax, dividend tax, capital gains tax, estate duty, what form of tax is my better option? Because one thing SARS does allow is for me to do better tax planning. SARS allows me to plan my taxes, to work with my taxes. What SARS doesn't like is me trying to run away from my taxes. So what we try and do is we look at all these things and we go, how can we plan it better? Because we're going to pay the taxes, but let's be wise about it. So that's why I wanted to bring this deemed dividend idea to you. There's other things where sometimes people take things out of companies and they don't understand. You cannot, yeah, but it's my business. Actually, you're a shareholder of that business. And you can't just take the company motor vehicle that's now been paid up out of the company and go and sell it and use the money for yourself. It is not actually your asset. As much as you'd love to think it is, it's not. So sometimes we need to just understand the separation of use and enjoyment and assets. And just because we're a shareholder or a member, we need to understand the separation there. And that's where these deemed dividends come in. And I think this is why I love the work I do so much with tax, because I don't do the physical accounting. I don't do the physical tax returns. I sit with my nose in my books and I do research and I find all these acts and I do the research and I do the planning and I build puzzles. I find ways of doing it better. And I work with accountants and I work with financial planners and I work with attorneys to see how one can optimize these things. And then I leave it to people to go and do the actual accounting, because we all have our own superpowers. You have a superpower in running your business, maybe, or you may be an accountant and you've got a superpower in doing accounting. My superpower lies in research and finding better ways of doing things. So understanding that a deemed dividend may very well happen when you do certain things and could trigger a tax. And it may not even be a deemed dividend. It may be a disposal, which would trigger a capital gains tax. So just understand that sometimes our actions result in certain taxes. Okay, let me not carry on here because I get carried away when I talk about tax. Next one, what are all the other taxes? Now here, I just want to touch on a couple of things. Personal income tax, as I said earlier when I opened this discussion. Why is it important? Well, hopefully we've all reached this point, if we are business owners, that we are paying ourselves a salary. If we're not, man, we need to readdress this. Okay. And so the personal income tax rates have changed slightly, apparently, to accommodate inflation. And so it's across the board like a 4.5% increase in the, if I can explain it in layman's terms, in the non-taxpayer bracket. So you know those brackets where you move it up to, before you start paying tax. That has caused a before you pay tax, the 4.5%. So as a business owner, what happens? Any salaries you pay, you've got a tax deduction in your business. Of course, it is in production of income. So you would have a deduction in your business. For your employees, they can earn a little bit higher before they pay tax. But here's the problem. And I've so often experienced this. You want to give your employees a raise because everything's become so expensive. Food, fuel, accommodation, everything's become so expensive. And you now want to give them an increase. But you have to be so mindful, because you give them an increase up to a certain point and they're still good to go. You just tip it over by 100 Rand and they're into a new tax bracket, and they take home less now than they did the month before the increase. So please be mindful when you are working with increases, with bonuses, with anything related to employees and their money and their taxes. Sit down with someone that understands the employee taxes, and see how you can work. Sometimes maybe working around a bursary, sometimes working around incentives, other types of things could be a better way to make sure that your employees are not worse off than better off. If your employees have been under the tax-paying threshold and they've never paid tax, and all of a sudden, through giving them an increase, they now end up having to pay tax, that could also create a very bitter taste, and you will land up having demotivated staff. So these are things that we don't always think about as business owners, because we go, well, they wanted an increase, they've got an increase, what are they complaining about? But we need to understand that it goes much further than that. So just be mindful of that. Even though they've upped it, they've only upped it by 4.5%. Often when we give increases, it may be more than that. And by giving an increase of, even if we give an increase of 4% on the higher brackets, they're out of that, and it may trigger them into a different tax bracket. So just be mindful of that. Employment tax incentives. What the government is trying to do here is they are saying, if you employ certain people with certain skills, certain ages, we will give you a certain amount back. You have to register for this. It's a certain process. Again, I don't want to go too deep into this in this specific discussion. If there is a need for it and there is a request for it, I can go deeper into employee taxes. I don't specialize in this per se, because this is not the kind of thing I optimize. Your payroll people will be able to help you with it. Your accountant should be able to help you with it. But basically what they've done is, in this budget speech, they've increased the thresholds or the payouts that the government says they will give you in order to improve unemployment. So they are hoping to get more people off the streets. They are hoping to get more people employed through this ETI. So what it goes to is employing people between 18 and 29. So they're hoping to get more youth employed. Okay. Fuel. Why have I put fuel here? Well, the reason I put fuel here is because fuel prices have increased tremendously. And government said in the budget speech, rah, we are not increasing fuel levies. Yippee-ki-yay. The thing is, at the end of the day, these are the things that creep into our business slowly. If we've got people on the road, if we are having to do deliveries, anything where fuel impacts our business directly, we need to look at this. So even though the levies haven't been increased, the fuel rates have increased dramatically. Have we looked at how that impacts and what that does on the employees if we do reimbursive travel, if we have car allowances, and even on our cash flow, our budget projections? Because remember, we would have had a certain budget for fuel. Has that budget been adjusted? Because believe you me, when you did your budget, the fuel price wasn't what it was. And the fuel price has gone up so dramatically, so quickly, that I don't know if you would have maybe even thought of reassessing that budget item. So very important that you look at that. But understand the indirect impact fuel will have on your business. Employees need to get to work. So what happens when people all of a sudden start going back to work? And this is already a problem, where people are starting to go back to work from now their COVID slumber, their home offices. They all of a sudden starting to experience the cost of fuel. And the people that have to take taxis to work, people are starting to feel the pinch where they have to get to work, but they haven't had an increase to accommodate the fuel price. And that directly impacts the morale and motivation of staff. Because no matter how hard they work, no matter how early they get to the office, no matter that they try and do their best, the money they get at the month end does not match the expenses. Not through anything they're doing, not through anything you're doing. It's the reality. So bear that in mind as well, that even though it's a good thing in the budget that we are not raising the fuel levies, and we have been the proverbial frog in the boiling water, slowly boiled with the fuel prices, have we actually sat down and assessed the impact the fuel prices are having on our budgets, our cash flow, and not the knee-jerk, oh my goodness, but the long-term view? If this, then that. Have we gone and measured? Have we had to adjust our sales, our costings? Because believe you me, we are now paying more for everything that we are doing. Everything that we are buying is costing more as a result of this as well. So do take that into account. But more so, I think often we look at the nuts and bolts and the physical cost of things, but we forget to look at the emotional impact. How is this impacting the human capital in our business? And we often choose not to look at that. But at the end of the day, your human capital they can move from an asset to a liability very quickly when we don't take care. Okay, last one up is VAT. Yippee, yippee, yippee. VAT at this stage, not changed. It's remained at 15%. There has been one change or one recommendation here that I will just touch on. Not sure how many of you are impacted by this. For non-resident suppliers of electronic services, required to register for VAT. So that these people are now required to register for VAT if the total value of the supplies to recipients in South Africa exceed 1 million in any consecutive 12-month period. So if a foreign company, non-resident company, supplies electronic services to South Africans, and in the year of assessment, so the 12-month period, the total of their sales exceeds 1 million. So basically like the same as for South Africans. If your turnover is going to exceed 1 million, you have to register for VAT. Then these people are now also to register for VAT. And then they say electronic services are defined with reference to those services prescribed by regulations. Now you can actually go, there are regulations in SARS that says what is an electronic service, and you can go and read more about that. But if you are, why is this important? Because if you are receiving any form of electronic services from non-resident companies that you on-sell, or that you make use of, that you previously did not have to pay VAT on, and you are not a VAT vendor, it means that you're not going to pay extra for it because you can't claim back that VAT. And again, these things will impact your liquidity, your cash flow. So all the things I've discussed is how will it impact my business? Not just, okay, there's been a change or no change. It's how does this impact my business? And I hope I've managed to get through that for you guys and explain that in better terms. So if we just go back to the top again, what have we discussed? Let's get my face out the way here. We've talked about the corporate income tax, where we are dropping from 28% to 27% effective March 2023, but it has the limitation rule to it. We've spoken about the turnover tax for micro businesses that remained unchanged. SMMEs, the only change there is that because of this corporate income tax rate dropping down to 27%, same will apply for SMMEs. We've spoken about the fact that although dividend tax itself does not change, the effective rate for the eventual shareholder may be impacted or is impacted, as well as be mindful of those hidden deemed dividends. We've spoken about personal income tax and why that is important for you as a business owner to take into account. We've spoken a bit about employee tax incentives. We've spoken about how fuel prices and levies may impact your business, and then also touched on VAT that has remained the same, but the impact it may have if you are dealing with non-resident suppliers of electronic services. Okay, so I hope that you guys have had some great learning in this session. For more assistance, if you guys need some planning and structuring, or you need to just make sure everything is in order, or you do need assistance with accounting and tax, please feel free to reach out to us. By now, you know our details. If not, everything will be posted also in the videos handles at the bottom. But thank you for your time. I appreciate it as always. I love just sharing this information with you guys, and I'd love to hear your comments on whether you found the information in this video of any assistance, and also to hear what else you would like me to maybe talk about and what else would be of assistance for your business. Yeah, like I said, for me, it's more a matter of finding solutions and optimizing. I don't myself get elbow deep in the doing. I am more in the thinking, planning, and structuring phase of anything than in the physical doing. I love working with accountants, with financial planners, with attorneys, on seeing how we can optimize businesses, estates, and trusts. So, as always, thanks, guys. Thanks for your time. It's been lovely spending this time with you and being of service here. Thank you.